So, Benjamin Graham, the famous guru, the man admired by Warren Buffett very much. Benjamin Graham felt you should not follow the crowd. Your portfolio should be 50% in stocks, 50% in bonds or cash, so somewhat balanced. Be wary of day trading. Market volatility is inevitable, so use it to your advantage. Be careful about the creative accounting that some companies use, so you need to kind of delve into how the company's really doing. What are you good at? Know yourself as an investor. So, yeah, that's important. That's kind of a new one. Are you kind of a gambler? If so, maybe it's not good to get into stocks. Or you need to change yourself. When investing, try to stay as safe as you can. Things will be volatile, but profit from it. The intelligent investor is a realist who sells to optimists and buys from pessimists. From Benjamin Graham's book, The Intelligent Investor, which is well worth reading. I recommend it. So his original formula for finding stock value is V equals EPS times 8.5 plus 2G, where V plus intrinsic value, EPS trailing 12-month EPS of the company. EPS equals earnings per share. 8.5 equals P over E ratio, price earnings ratio of zero growth stock. G equals long-term growth rate of the company. His philosophy, never lose money. 2, never forget number 1. Play the long game. He's the father of value investing. So there's the book, The Intelligent Investor, which I have, and I recommend you get as well. He says to analyze companies for value over crazy risks. Mr. Market is crazy, especially in the short term. Use a formula and stick to it to make all investments. So again, keeping your emotions out of the equation, following a strategy, and, staying with that. Good advice.